U.S. stocks selling off after a weaker than expected jobs report for July. The signs of a cooling labor market stoking fears the Fed has waited too long to lower interest rates and renewing concerns about a recession now on the horizon. Joining us now to discuss all this is Jason Draho, UBS Global Wealth Management Head of Asset Allocation Americas. Jason, it's good to see you. So let's dig right into this sell-off, Jason. It's clear more investors have some questions now about this U.S. economy, Jason, just where it is and where it's going. What are your thoughts?
Well, if we just take the totality of the data, but looking particularly today with the labor market report, the way we would interpret it is the data has been consistent with the idea that we've had that the economy is going to slow this year from an elevated pace last year, and that's consistent. It is the labor market is going to cool and sufficient so that the Fed could start cutting rates in September. But I wouldn't interpret the data we got today or this week as really dramatically altering the odds of a recession. We still think it's a soft landing. We still think the recession risk is unlikely. And the reason I'd say that is if you look at just the overall state of the household and the consumer, we saw it actually tick up in March. The overall kind of health of the consumer is in good shape. That is the most important part of the economy. And in the labor market, certainly the job growth has moderated, but what you haven't really seen is any real uptick in initial claims. Yes, they've risen a little bit recently, but if you look over the past 2 years, they're pretty flat. In past periods, when you saw the labor market weak and you saw the unemployment rate rise, you'd also see kind of a corresponding increase in the initial jobless claims. That has not happened. So what it looks like is that we're seeing a moderation of job hiring, but also not a lot of layoffs, and the labor supply in the past year has increased. And that's why the unemployment rate has gone up. So it's kind of giving a bit of a false, say positive in terms of how much the labor market's weakened. And so we sort of remain confident in the overall trajectory of the economy right now.
So, Jason, given that view, then, I wouldn't call today a market panic necessarily, but maybe a market alarm, right? An alarm being expressed by some economists and strategists. Do you think that market reaction is unjustified? And does that then open up opportunities for those who have a view similar to yours?
So I think the way we'd view it is if the S&P is down 6% roughly from its all-time high just a few weeks ago on July 16th. So the risk reward in our view is, it's at least for the S&P, is it improved. The tech sector is down about 12% of that time. We like the tech sector, so I think the risk reward again there has improved. In the very near term, though, it's likely that the market's going to certainly remain choppy, volatile, and given investor concerns about the Fed now maybe being behind the curve, that growth is slowing. If that gets any worse, if those kind of concerns rise, I think there's more risk to some downside. But I kind of think this is a little bit of a replay with a twist to what happened late last summer, last fall. The S&P fell 10% on the concerns that the economy was too hot and the Fed would actually have to make things more restrictive. Ultimately, that proved not to be the case and the markets rallied. I think this is a bit of a kind of a growth scare that's unwarranted to some extent, at least in terms of recession risk. And at levels of maybe we're down 10%, that's when you start to get investors want to come in and kind of buy. So I think we're selectively looking at opportunities, but I think then in the near term, the next few weeks, next month or so, it might just continue to be kind of sideways choppy in this range before the kind of a real turn happens, potentially with the Fed actually starting to cut rates in September.
Yeah, I want to pick up on that, Jason, because I'm interested in what you think the Fed's next move is in September, because there were plenty of economists and strategists today, Jason, who were I think they were looking at the data and say, Jay Powell may not do 25. He could do 50 in September. What do you think?
So we changed our view. We were at 50 basis points of cuts this year, 25 in September, 25 in December. Now we're saying 100 total, beginning with 50 in September. And the rationales, even relative to 2 days ago, when from the FOMC statement, from the press conference, Powell had alluded to that they will watch very closely the labor market data. This is further data since just in the past 2 days that suggest a cooling of the labor market. We're also sort of making a bit of an assumption, almost kind of going back to what happened 2 years ago when it was the Fed was accused of being behind the curve. They did a couple 25s, and then very quickly they ramped up to 50 and 75 basis point, rate increases to fight inflation. If you think the economy is slowing and inflation is going to come down enough, and you think policy is restrictive, it's not clear why you need to kind of go very gradual. If you want to get back to something closer to a neutral policy rate, say 4% or less, you should probably start with a bit of a bigger bang. You move with 25 basis points to curtail the risk that maybe the recession risk is rising. So that's the justification for why we think they would go 25. But again, our soft landing kind of view is not conditional on the Fed now doing 100. We still think the economy okay. If anything, that's a net positive in my view for kind of risk assets overall if the Fed acts sort of aggressively and sort of offers insurance to the market.
Jason, it's really interesting that you say that, because I would think if they cut a half point, that'll spook the market, right? That they'll take the interpretation not as the normalizing that you're talking about, but rather it's a dramatic move that, I mean, you've got some strategists out there, economists out there saying, floating the possibility of doing an emergency cut even before that meeting.
Where I would sort of differ on that view is that ultimately we don't think the data is going to slow enough between now and then, like now and mid-September. If it turns out the data continues to deteriorate and deteriorate quickly, then it might be the case that, look, you're kind of past the point of inflection point where the Fed really is too late. So doing 50 is a signaling that they were concerned and it's already not enough. If the data continues to kind of hold up, like if we get a jobs print for August that is aligned with this month, I think that sort of validates the view of 50 basis points, but it's also not a sign that the economy, to me, is about to kind of tip over. And now that the Fed is starting to cut in line with the market's pricing, I think that would actually be a relief to the market, that it's, the adage of the investors stop panicking when the policymakers start panicking, and a 50 basis point cut, I think, would be interpreted more in that vein versus a negative signal. They know something that we don't know about the direction of the economy.
All right, good stuff, Jason. Thank you so much. Appreciate it.
You're welcome.